Hello, friends. Welcome back to Mindful Finance. Today, we are going to get into another episode of a ratio which is called price to book ratio. There are multiple options or the multiple way people look into the value investing, and in that, one of the method is price to book ratio. Look into this video, watch completely. It will give a complete clarity about when to use PB and what is PB, and how it will be helpful to find a undervalued stock. And this is Sundar, and you are watching Mindful Finance. What is PB ratio and why it is important, where this PB ratio can be applied, and how to apply that. So let's get into that. First of all, what is PB ratio? PB ratio is price to book ratio. And what is the formula for that? Price by divided by book value. Now, when we say book value, we need to get an clarity about what is book value means. Now, take an example of the home you buy. What you do, you will find out what is the price of the land, and if the building was constructed on the top of the land, you will try to find out is there any value that building also brings to the land. In case if you are going to demolish that building and you are going to make a new building, then the building value is completely negligible, right? So you will only consider the land value. You will not put a cost for the building. So because the building is a depreciation cost. Another way of looking at it is it would have been built like 20 years back or 30 years back, and the quality of the building would have been degraded. So the price for the building would have been gone down, but the land price, it would have been appreciated, right? So within the assets, you have depreciating assets, also increasing asset, value increasing in the asset, right? There are two scenarios. If you buy a car, when you buy the car, immediately it starts to lose its value. So those are depreciating, and cars are not called as cars are not called as asset. These are liabilities unless and until the car is used for a business. Let's leave that aside, but get into our home analogy. So what you said is your land price has a cost to that. So now that is your asset. On the top, you are constructing a factory now. Okay, the factory will come up with lot of equipments, machineries, and because you need to make some bottles, something you have planned to manufacture. Now those also will come into your assets, but that assets will have a depreciating value. It will have a maintenance, it will have a lot of things, right? So those will have a value, but it will be very less. So when somebody is valuing your company, they'll look at your land, they'll look at the equipments you have, they'll look at the investments you have made, right? So all these physical assets are called or will contribute to your book value. So basically, book value, how you will arrive is assets minus liabilities. If you have bought that land for a loan, that's a debt, right? So that you have to minus your assets with that debt. So basically, you have to minus your liabilities. Whatever the things comes out of the liabilities, then that will become your book value. So basically, book value is assets minus liabilities. Liabilities also includes if the company is trading, and it will include the equity capital share. Okay, how many equities they have raised. So that will also come under the liabilities. So basically, assets minus liabilities. Now, what is the formula for book value in the PB ratio, which is price to book value? So current market price divided by your book value. So that is how you will arrive a ratio now. Okay. Now take an example. A company is having a price of the current market price of that company is say 100 rupees, and your book value is now 200 rupees. That is arrived by assets minus liabilities. For example, your assets was 500 and your liability was 300. So your book value comes 500 minus 300 equal to 200. So your book value is 200 now. Your current market price is 100 rupees. So 100 rupees divided by 200, that will give you your book value. That will give you your price to book value. Now the price to book value is a number to understand how much it is undervalued or how much it is overvalued. For example, if the book value comes to 1, that is your fairly priced. It is because it's equal. And if the book value comes less than 1, that means it is undervalued from the price to book value ratio concept. Can I apply this ratio for all the companies? No, that's not possible. You have to think about the companies which are very much dependent on physical assets. If you take IT companies, even with the one simple room, they can accommodate people, set up a server, you can work from anywhere. So people are not called as asset in IT company, but the entire thing runs through only people. So in that case, if you see their assets will be very low. So that means the price to the book value will be very low. So that doesn't mean that IT companies are trading cheap. Their book values are low, right? It's not like that. You cannot use PB ratio for those kind of a company. So where I need to check PB ratio? The companies which are having a good amount of assets, the company completely rely on some assets like machineries. There are companies run based on their patents they have acquired, like pharmaceutical companies, bank mainly, finance institutions. They mainly valued based on price to book value, because how much assets they have is very important for banking, because banks will have more debt, or whatever the companies which are running with a lot of physical assets, they would have got so much loan to build that capital or build the company. Take an example of Tata Steel. Their business is mainly manufacturing. Their equipment, the industry, capital or construction cost, that would have been very, very expensive. So obviously they would have got too much of loan for constructing that company, right? The building the unit. So in that case, you have to rely on PB ratio. If you find a good PB ratio and the revenues are not, you cannot just simply look at PB ratio also, right? You have to think multiple angle. Not you have to check the revenues, you have to check how the flows are, right? So those also things you have to check. But PB ratio will give a quick interpretation of whether which are like more rely on those kind of a capital, those kind of infrastructure. We can use the PB to understand whether it is undervalued or overvalued. Let's check some example. Let's get into the example. Let's check this example here. Okay, we are looking at Bandhan Bank. So this is a bank. So since it's a bank, it's very important we need to look into book value and price to book ratio, right? Now if you see the book value is 122, how the book value was arrived? Assets minus liabilities. Okay, you don't need to get into the normally you have to go and check the balance sheet. Okay, here if you see total liabilities and total assets, if you minus this one, it will become 0. So you cannot do assets minus liabilities like this. So you have to get detailed about that one. You have to check the equity capital and other things. So don't complicate. It's a screener website, there you can get all the details, all the ratios now, right? So here you can find the book value, which is 122. The current market price is 188. So PB ratio is price to book, which is 188 by 122. You'll get a ratio of 1.54, which means it is trading at 1.5x, right? 1.5 times of its book value. Since it's a bank and it relies on more of capitals like debt and other things, this is very important to look at this one, whether it is undervalued or not. The first thing, based on the price to book value, it shows like almost it's fairly priced. It's more than 1, right? So less than 1 is undervalued. It's more than 1. So it's fairly priced. Not 2x or 3x. But normally in banking sectors, price to book ratio of 3 is considered as a good bet or fairly priced ratio. Okay. Now check. Now let's look into the revenue. How are the price to book ratios growth? Let's see the price to book ratio, how it grown in the past. If you see, initially it was here, it was 6.3 times it was trading, right? Now it has consolidated. If you check the chart, okay, you can see that price is going down. Okay, keep on going down. So now at this point of time, you can see price to book value is 1.5. Earlier it was almost 6.3, 6 times. Okay. So that's why it was considered as overpriced, and currently it is consolidating and it is going down, even though the company is doing good, the bank is doing good, the revenues are increasing, right? Let's see other bank. Okay, Karnataka Bank. Let's take Karnataka Bank. What is its book value? It is 263 and PB is 0.87. What does that mean? It's less than 1. That means it shows it's undervalued. From the PB ratio, we understood it's undervalued. Now let's see whether it's really undervalued. Let's check the past history of PB. If you see, very interesting here. The PB is increasing here, right? It is increasing. See, PB is slowly from 0.3, it is keep on increasing. So their assets are that means their assets are increasing. Their debts are coming down, or their assets are giving more revenue for them, right? That is how you have to think, and check for the growth here. Check its revenue growth here. See how it is. It is constantly, it is growing. So there is no doubt that this is doing bad, right? Its revenue is growing. Its CASA ratio is increasing. Its gross NPA is 3.9%. Earlier it was high, but it has reduced. Now check Bandhan Bank. Okay, we need to check. So Bandhan Bank also, if you see the NPA, it will have been reduced now. It also had a very high NPA. NPA is non-performing assets, which means you would have given a loan and the person has not paid the interest back, or any company got loan from the bank and they didn't pay interest for that one, or the company got bankrupted. So whatever the amount you paid for that particular industrialist or business person, it is gone now. So those are called NPA, right? Okay, so in that case, now you can compare. This is 1.54 and Karnataka Bank is 0.87, right? So both are Karnataka Bank is undervalued, Bandhan Bank is fairly priced. Now we'll check South Indian Bank. How South Indian Bank is. Book value is 25, current price is 28, and what is its book value? It's 1.13. It is more than 1. See, even though the market price is like current price is less, 28.8, but Karnataka Bank, if you see, it's 229, and say Bandhan Bank, it is 188. So your current market price doesn't matter, right? See, its book value is 1.13, which is more than its normal price, right? It's a bit expensive than Karnataka Bank. But if you see the price, it looks like higher. But South Indian Bank is cheaper. It will look like cheaper for you because the market price will not give a clarity about whether the stock is cheap or overvalued. First of all, okay, you might see that. Let's look at another thing. I'll show another example to demonstrate it one, which is Dr. Reddy. Okay, what I'm showing is current value shows 6,350. Its book value is 1,500. So price to value is 4 times. It's 4 times. But the book value is 1,000. Okay, so it's 4 times its trading. So by looking at the book value, it looks expensive. But for Dr. Reddy's, will I look into book value or the PE? I'll go for PE first, and then I'll come to PB. So when I see PE, Dr. Reddy's PE, how it is doing, it is trading at very low, right? So that way, first you have to understand which company to look, or where for which company what ratio to look. So here it is very clear. It is not a banking sector or anything. It is trading good. Let's take Tata Steel now. Tata Steel book value is 72, current price is 166, and it is trading 2.3 times, 2x. It's a very capital intensive company, this is, right? But it's fairly priced. It's 2.3 times, it's okay, but yeah, it's more than 1. It's fairly priced, but not highly. Stock P is 107. Let's see the stock P. Stock P is so high. What is the average P? Industry P is 19, but Tata Steel is trading at 107. 107 PE. So whether I will look at the PE or PB here. So here I will check first PB. It's overvalued, right? It's more than 1, but maximum we can go with a 3 kind of thing, right? 3 is good to go with. So in that case, this is second you have to check PE. First is PB, then PE. Now it looks like P is high, so PB is okay to buy, but P is high. So I'll try to avoid this company for now. Okay, if the PE also goes down, I'll try to buy. So and here see the price is 166. It is expensive now. Bandhan Bank is 188, but we are considering that as a cheaper one. So this price doesn't matter for you. And Karnataka Bank is 229, but it is undervalued, like less than 1. So this current value is something that we are ready to pay. So don't confuse with the price and the value of the company. If you go to penny stocks, any of the penny stocks, the price might be like 2 rupees or 3 rupees, but if you probe in a detail, you will find that that is very expensive price. 2 rupees is not even worth for that company. So don't get prey for this kind of a thing. So you should not worried about the price when the book value is less than one like this. And also if it is like having a good amount of revenue if the company is making. So this is Karnataka Bank. It is making a very good revenue. If you see, it is increasing consistently. It is increasing. So you don't need to worry about this one. It's not a stock recommendation, but that is how you have to assume this one. Now hope you understood why PB ratio is important and where to use the PB ratio. Using our different formulas to calculate undervalued stock, intrinsic value, and this kind of a ratio, understanding this ratio gives you more insights, and you will have a more informed decisions making capability. So that is my goal. Okay, if you find this video really like valued, and if you feel you will learn something new, please do like this and subscribe this, and please do comment on this video if you find any stock which you find as undervalued, and don't forget to press the notification icon. Thank you.